Today we're going to be talking about how income is taxed in the United States. So in this lesson we'll be talking about federal or IRS income taxes, as they're usually the most substantial in terms of percentage of tax assessed on your income. Now there are two main types of federal income tax. There's an individual or personal income tax, those are the same thing, and there's a corporate income tax. Let's start with the individual income taxes. This affects nearly every American every year. We all file a tax return on Form 1040, and upon filing the tax return based on the amount owed and what we've paid in, a tax payment is made to true up the balance owed to the IRS, or a tax refund is received if you overpaid the IRS. That means that if you receive a refund, you gave the IRS a loan because you overpaid them and allowed them to hang on to your money for a few months that wasn't actually theirs. The calculation for taxes assessed on your income in a given year is done simply by applying a tax rate, which increases as your income increases, to your total taxable income. Before you can calculate your taxable income, you need to determine your gross income. And to do that, you need to add up all of your income from your W-2 job, your self-employment earned income, interest, dividends, rental income, stock sales, retirement distributions, etc., etc. Your total taxable income is your gross income less any applicable business and personal deductions. And personal deductions can be mortgage interest, charitable donations, IRA contributions, etc. And your taxable income is then taxed based on marginal tax rates. This chart shows the tax rates for a single filer in 2020. It schedules out the various rates and the corresponding increases in taxes owed. Note that when you move up a tax bracket, your taxable income is not all taxed at that rate. Even for a single taxpayer earning $1 million a year, the first $9,875 of their income is taxed at only 10%, and the next $30,250 is taxed at 12%. Only the amounts they earn over $518,000 are taxed at the highest rate of 37%. As with everything in tax, there are a few exceptions. So long-term capital gains, which is another term for income generated from the sale of an asset held for more than 1 year, are taxed at a lower rate. Depending on your income, it can be as low as 0% or as high as 20%, but still lower than the top tax rate of 37%. And self-employment income, pass-through income, meaning that the profits pass through to the owner's personal income tax return from all entities except S corporations, are also subject to self-employment taxes in addition to the regular tax as part of their income tax calculation. Self-employment tax rates are 15.3% of the first $137,000 of self-employment income that you have. This is why self-employed individuals hate taxes, because they're both the employee and the employer in the scenario. So you pay both sides of the taxes. As a W-2 employee, your employer pays half of your Social Security and Medicare taxes, and you pay the other half, so it doesn't sting as badly. The good news is that if you do have a W-2 job and self-employment income, you'll hit that cap of $137,000 sooner, and you won't have to pay that high rate on both streams of income. Note that self-employed earned income was emphasized above. That's because owners of sole proprietorships, single-member LLCs, partnerships, or S corporations, which are all pass-through entities, meaning that the profits pass through to the owner's personal income tax return, pay tax every year on the amount of income they earn in a given tax year, not how much they, the owners of the business, take out of the business. So even if you earn $75,000 from your consulting business, but you leave $65,000 in the bank account to build up your cash position, you as the owner of the business will include the $75,000 that you earned as part of your taxable income, even though you only took out $10,000 from the business bank account to put in your personal bank account. Now, that may seem kind of messed up, but since you already paid tax on that income, once you do decide to reward yourself with a payment from the business bank account, that distribution or draw or dividend is tax-free. Once you've taken into account your income, less your deductions to find out your taxable income, you'll be able to use the tax table applicable to your filing status to know exactly what your total tax is. Now, the last step is to figure out if you can apply any credits against your tax owed. The most common credit is the child tax credit, which is worth $2,000 per child. If you have 2 children and you owe $5,000 in taxes, your $4,000 of child tax credit reduces your tax bill to only $1,000.
Oh man, yeah!
There are also education credits that are popular. Once you know if you qualify for any credits, then compare what you owe the IRS to what you've already paid in, either via your W-2 or via tax estimates that you made during the year. And then you'll know whether or not you owe the IRS money or if they owe you a refund. Here's an example of Colleen's tax return. She earned the same money during the year, $57,000. And the only difference is that she had more income taxes withheld with every paycheck during the year. So when she files her tax return, she'll get back $2,000 instead of owing $1,000. So this means that she received less with each paycheck that she received during the year, but she also doesn't owe the IRS anything when she files her taxes. So that was personal income taxes. Next up is corporate taxes. This affects much fewer tax filers every year, but it's important for business owners to understand because this is a common misconception that business taxes are assessed on all business earnings. Only businesses set up as C corporations file a Form 1120 and pay a corporate income tax. A C corporation pays taxes at the business level. In 2020, the tax rate was 21% on all business income. And then dividends and wages paid to the owners from the business are also subject to individual income taxes, which is where double taxation comes from. Now, while states and local taxing authorities tax pass-through entities at the business level, most businesses will never pay the IRS any corporate income taxes. So what about state and local income taxes? When discussing how income is taxed in the United States, the focus for conversations is usually around federal or IRS taxation of income. However, states and local taxing authorities also assess tax on your income, usually at a much lower rate than federal. So most state and local taxing authorities use earned income to calculate taxable income. However, there are certain jurisdictions, like Philadelphia, who tax unearned income, like interest, dividends, short-term capital gains. And some municipalities assess tax based on gross receipts or sales of a business. So always research which taxes your business is subject to. Discuss with other business owners in your area, with a lawyer, with your accountant, to ensure that all your bases are covered for your business and yourself. If you found this video helpful, we're real accountants and CPAs who work with hundreds of small business owners just like you every day. Check us out at engagecpas.com to see if we're a good fit for your business. We also have business courses available to help small business owners understand their business. They're for you to learn about your financials, your taxes, how to pick the right entity, tax myths, and everything else about your business. Learn at your own pace. Check those courses out on the Education tab on our website. You can also find us on Instagram at Engage CPAs.